Inflation is one of the most important economic concepts because it directly affects how people live, spend, save, and make financial decisions every day. In simple terms, inflation refers to the general increase in the prices of goods and services over time. When inflation rises, the purchasing power of money decreases, which means the same amount of money can buy fewer goods and services than before. For example, a grocery basket that may have cost 1,000 pesos last year could now cost 1,100 pesos, or even more. This increase is often felt in food, transportation, fuel, rent, electricity, healthcare, and other daily necessities. While moderate inflation is considered normal in a growing economy, high inflation can create financial stress for households and businesses alike. For individuals and families, inflation has an immediate and visible impact on daily budgeting. Essential expenses such as food, rent, school costs, transportation, electricity, and water bills often increase first, forcing families to adjust their monthly spending plans. Many households respond by reducing discretionary spending such as dining out, shopping for non-essential items, or postponing travel and leisure activities. Lower-income and middle-income households are often more affected because a large percentage of their income is already dedicated to basic living expenses. Even a relatively small increase in prices can create significant pressure on their finances. Over time, continued inflation can reduce the quality of life if wages do not rise at the same pace. Inflation also changes consumer behavior in important ways. When people expect prices to continue increasing, they may accelerate certain purchases to avoid paying more later. For example, consumers may buy appliances, gadgets, furniture, or vehicles sooner rather than later because they expect prices to rise in the coming months. At the same time, uncertainty caused by inflation can also make consumers more cautious, leading them to delay large purchases and focus on savings or necessities. This shift in behavior directly affects overall demand in the economy, which in turn influences business planning, inventory decisions, and production strategies. Businesses are significantly affected by inflation because rising costs directly impact operations and profitability. Raw materials, transportation, utilities, labor costs, and supplier prices all tend to increase during inflationary periods. For example, a restaurant may face higher costs for ingredients, cooking gas, electricity, packaging, and wages. Retailers may need to pay more for inventory and logistics, while service-based businesses may see higher operational expenses. Businesses are then forced to decide whether to absorb the costs, improve efficiency, or pass the increase to customers through higher prices. This is one of the most critical business decisions during inflation, because pricing changes can influence customer demand and brand perception. Inflation also plays a major role in financial decision-making for both individuals and businesses. Central banks, such as Central Bank of the Philippines, often raise interest rates to slow inflation and stabilize the economy. Higher interest rates make borrowing more expensive, affecting home loans, car loans, personal financing, and business expansion plans. Consumers may become more cautious about borrowing, while companies may postpone investments, expansion projects, or equipment purchases. At the same time, higher interest rates can make savings more attractive because deposit accounts and fixed income investments may provide better returns. Another major effect of inflation is its impact on wages and salaries. If salary increases do not keep pace with rising prices, the real income of workers declines. This means that even if a person receives the same salary as last year, their ability to afford daily necessities may decrease. Employees often seek salary adjustments or cost of living increases during periods of high inflation. For businesses, this creates additional pressure because labor costs may rise while consumer demand becomes more uncertain. This balance between wage growth and inflation is a major concern for both policymakers and business leaders. Inflation can also influence investment decisions and long-term financial planning. Investors closely monitor inflation trends because rising prices affect the performance of stocks, bonds, real estate, and other asset classes. For example, high inflation may reduce the value of fixed income investments, while increasing interest in assets that can better preserve value over time. Businesses also use inflation projections when preparing budgets, forecasting revenue, and planning capital expenditures. This makes inflation not only a consumer issue, but also a strategic concern for investors and corporate leaders. In the Philippine context, inflation can be strongly influenced by food prices, fuel costs, transportation expenses, and global supply chain disruptions. For example, increases in rice prices, oil prices, or electricity rates can quickly affect the daily expenses of households and the operating costs of businesses. Because these costs affect multiple sectors, inflation often spreads across the economy. This is why monitoring data from agencies such as Philippine Statistics Authority is important for understanding current economic conditions. Understanding inflation is essential because it affects nearly every financial decision people and businesses make. From daily budgeting to pricing strategies, from salary negotiations to investment planning, inflation shapes economic behavior at every level. By understanding how inflation works and preparing for its effects, individuals and businesses can make smarter decisions, protect financial stability, and adapt to changing economic conditions.